Not that much going on today to start the week, so we're really going to focus only on the Canadian Producer Price Index number that's coming out. And today's trading takeout is going to be really to hammer home this concept that I've been speaking about on, relativity and how data matters only when in relation to other data points or other pieces of sentiment. So the Canadian Producer Price Index is out today, later this afternoon. And I think it's really, really important considering this recent uptick in oil. Now, Canada is a key producer of oil. The Alberta oil sands is one of the places that produces a lot of oil. And it's one of their key exports as well. And I think in terms of producer prices here, they tend to feed through to consumer prices. So producer prices are the prices that producers pay for inputs, oil being one key one. Energy is absolutely vital for pretty much everything. And the uptick here is likely going to cause a broader effect on the upwards inflationary pressure in Canada. And I've kind of juxtaposed the CL contract, so oil futures, against Euro CAD here. And the reason why I've used Euro CAD is because at the moment we're seeing kind of a dovish narrative coming out of the ECB. So dovish means, the ECB have brought forward their rate cuts from September, or the market has brought forward their prediction of the ECB cutting rates from September next year to June. I mentioned that in a video just last week. And with regards to the PPI in Canada, it could be, because of this uptick in the oil price, it could be inflationary. So what we're doing there is we're playing the relative data, and we're going to get off this onto the trade and takeout in a bit. We're playing the relative data here, which from my view, shows a change in interest rate differentials. So what we're looking at and what we're betting on is an increase in inflationary pressures in Canada versus the static or decreasing inflationary pressure in the Eurozone. And you're just playing off those two yield differentials. You're playing off the interest rate differentials there. So this is what this trade idea is based on, effectively. And you can see as well, let's take away the oil contract. You can see as well that what we're looking at here is a lovely support level through here, okay? Now, there's two things that you can sort of note about support levels, especially when it's kind of a head and shoulders pattern. So they can break, but also they can do fantastic false breaks. Now, it totally depends on the time frame that you're looking at. But from my perspective, if we're looking at this on the daily chart, if you were to go onto a lower time frame here, so if we go onto the hourly chart, I would say there's sufficient room for the market to trade lower by about maybe 100 odd ticks until we get a reversion to the upside again. So what you tend to see with blatant patterns is that they don't play out straight away. So you'd be kind of meandering along here for a little bit. It's likely that you trade along here. Ooh, just get the drawing tool. You trade along here, probably trade back up there, and then you might see the move in a couple of weeks' time. But you can see, the whole thematic play there is really just trading an inflationary pressure in outside the Eurozone versus deflationary or disinflationary pressures inside the Eurozone, causing that interest rate differential to increase in favor of Canada or most countries outside of the Eurozone. So that's really what the trade is. We'll see if it comes off. It could be an interesting one, but that's only really going to occur if we see that Canadian producer prices come in hotter on a month-on-month and a year-on-year basis. You tend to find, strangely, that Canadian producer prices are categorized as low on your calendars, when really I think they should be mid to high. The importance changes on context of what the market's looking at right now. So it's really, really key to understand the importance of interest rate differentials when you're looking at FX. And it should really be the key anchor that you have at the top of your ideas pyramid when you're coming to construct an FX trade idea, because pretty much all markets move off of interest rate differentials. You then get sort of second and third order effects that matter too, but really it's interest rates that matter for everything. Now, let's kind of explain this with an example. So let's say one economy is increasing their interest rate and one is decreasing, such as, the example of the Canadian PPI number that I referred to earlier in the video. What this means is that people are likely going to push their capital towards the economy with the higher interest rate, while either selling or, basically not pushing capital into the one with the lower interest rate. Now, this is to take advantage of bond yields. Now, it's a funny one because what it actually can occur is, let's say, low interest rate regime in the US is going on. Dollars are bought to buy US equities. However, they're effectively sold when those US equities are bought. So this makes it quite interesting. I'm really referring to fixed income here when I'm talking about capital flows. But one of the big things that institutional investors do are carry trades. And this is really the crux of what I'm getting at. When we're looking at FX, we want to be trying to conduct quite a nice carry trade, going with the positive flow of interest rates and going against the negative flow of interest rates.